Imagine this for a second. Japan, the largest foreign holder of U.S. government bonds, holding over $1.1 trillion worth, suddenly decides to sell even a portion of those bonds. The impact? The US dollar could weaken sharply, interest rates could spike overnight, and panic could ripple through global financial markets. Now here's the real shocker. This scenario isn't some distant possibility. It's a rising concern in today's global economy. Bond yields across the world, from the United States to Japan, have been climbing rapidly since 2022. But why? What's really going on? And more importantly, why should you care? To understand this, let's start with Japan, a country once known for near-zero interest rates and decades of economic stagnation. But now it's facing a dangerous mix of problems. Its debt level is staggering, over 270% of its GDP, the highest among developed nations. And the situation is worsened by a shrinking working-age population, which means fewer taxpayers and slower economic growth. All this is making investors nervous. And that nervousness is showing up in Japan's bond market. Yields are rising fast, where it connects to the rest of the world. Japan isn't alone. Government debt is surging everywhere. Back in 1973, global government debt averaged about 40% of GDP. Today, it's over 110%. And in the United States, the world's largest economy, the numbers are getting more alarming every year. Rising fiscal deficits, increasing interest payments, and record-high national debt have all started to shake market confidence. Investors now demand higher returns to lend money to the government, which is why bond yields are shooting up. But here's the catch. Rising bond yields mean falling bond prices. When yields go up, it usually signals that investors are worried. They're worried about inflation, about debt sustainability, about central banks losing control. In Japan's case, things are even more complex. The Bank of Japan has historically followed a strategy of quantitative easing, printing money to buy bonds and keep interest rates low. But now inflation is returning after decades of deflation. That puts the central bank in a tight spot. If they try to ease again, they risk making inflation worse. If they tighten policy, they might cause a recession. It's a lose-lose situation. And because Japan is such a massive holder of US debt, any sudden move by its central bank or its investors can impact the American economy too. If Japan starts selling U.S. bonds to stabilize its own currency or bond market, it could push U.S. bond yields even higher, make borrowing more expensive in the U.S., and deepen the current fiscal stress Washington is already facing. In simple terms, the world's largest economies are walking on a financial tightrope, where one wrong move could trigger global consequences. Bond yields are not just numbers on a chart. They reflect trust, or the lack of it, in a country's ability to manage its finances.